These are the 5 index funds I'm using to retire in my 40s. In this video, I'll show you the exact percentages I put into each one and why. No hype, no guessing, no complicated strategies. Just a simple portfolio designed to compound quietly over time. I'll break down what each fund actually does, how they work together, and why this setup gives you a real shot at financial freedom without staring at the market every day. I'm Peter. Personal finance and wealth building completely changed my life, and if you stay through all 5 funds, you'll understand why this approach works even if you're starting later or don't want unnecessary risk. Let's get into it. 1. VOO, the S&P 500 Foundation. All right, the first index fund is VOO, the Vanguard S&P 500 ETF. This fund tracks the S&P 500, which is basically the 500 biggest companies in the US. We're talking Apple, Microsoft, Amazon, Google, the heavy hitters. I put 40% of my money into this fund. Now, why does this work so well? Well, you're essentially buying a piece of the entire American economy. When you invest in VOO, you're not betting on one company or even one sector. You're spreading your investment across 500 of the most successful businesses in the world. Historically, the S&P 500 has returned about 10% annually over the long term. That means your money doubles roughly every 7 years through compound growth. And here's the beautiful part. You don't need to pick individual stocks, time the market, or have some MBA to make this work. You just buy and hold. The fund automatically rebalances itself. Companies that fail get replaced by new winners. You're always invested in America's top performers without lifting a finger. Let's talk numbers for a second. Over the past 30 years, the S&P 500 has averaged around 10.7% annual returns. If you'd invested $10,000 in an S&P 500 index fund back in 1994, that would be worth over $200,000 today. Even through the dot-com crash, the 2008 financial crisis, and the COVID pandemic, this fund has recovered and reached new highs. The expense ratio on VOO is just 0.03%, which means you keep more of your returns instead of paying them to fund managers. Now, I know what you're thinking. What if the US economy crashes? Here's my take on that. If America fails, I'm not going to be retiring at all. I'll be hunting squirrels for dinner. So yeah, I'll bet on the US economy. The reality is, if the American economy completely collapses, your cash probably won't save you either. So I'm comfortable making this my foundation. 2. VXUS, your global diversification play. The second fund is VXUS, the Vanguard Total International Stock ETF. This fund covers all my international investments, everything outside the US. I put 20% into this fund. This is what VXUS actually gives you. You're getting exposure to thousands of companies across developed and emerging markets. We're talking Europe, Asia, Latin America, everywhere. Japan's tech innovators, Europe's industrial giants, China's growing consumer market. You're not just an American investor anymore. You're a global investor, and that matters because different economies grow at different times. Here's why international diversification is so critical. The world is bigger than America, and I do want diversification beyond just American companies. Sometimes international markets outperform the US. In the 2000s, international stocks crushed US stocks for nearly a decade. Right now, international stocks are often cheaper than US stocks based on valuation metrics. That means more potential upside. Plus, you're hedging against the dollar. If the dollar weakens, your international holdings can actually increase in value. You're also tapping into growth in developing economies that might expand faster than mature US markets. The numbers back this up too. VXUS gives you access to over 8,000 stocks across more than 40 countries. The expense ratio is just 0.08%, so it's still incredibly cheap to own. Over the last 15 years, there have been multiple periods where international stocks outpaced US returns. By holding both, you smooth out your overall returns and reduce the risk of being too concentrated in one economy. Some people worry that international investing is riskier. And yeah, there's currency risk and political instability in some regions. But remember, you're diversified across thousands of companies and dozens of countries. One country's problems don't sink your whole international position. Think of it as insurance for your portfolio. 3. QQQ, the Tech and Innovation Engine. The next one that I invest in is QQQ, the Invesco QQQ ETF. This is basically investing in the NASDAQ 100, a ton of tech and growth companies. I put 25% into this fund. QQQ focuses on the 100 largest non-financial companies on the NASDAQ exchange. This is where innovation lives. We're talking the companies that are literally shaping the future. Tesla, Nvidia, Meta, Netflix. These are businesses disrupting entire industries, creating new markets and experiencing explosive growth. This fund is more aggressive than VOO, but that's exactly why it's in my portfolio. Why does this strategy work? Because if AI takes over the world, I at least want my portfolio to be on the winning side. Seriously though, technology has been the fastest growing sector for decades, and there's no sign that's slowing down. Artificial intelligence, cloud computing, electric vehicles, biotechnology. These aren't just trends, they're fundamental shifts in how the world operates. QQQ gives you concentrated exposure to these game changers. The companies in this fund are leaders in innovation, which typically means higher growth rates than the broader market. Yes, it's more volatile, but over time, that volatility has been rewarded with higher returns. Since 2010, QQQ has averaged annual returns over 18%. Let me break down those returns. A $10,000 investment in QQQ in 2010 would be worth over $100,000 today. That's 10x your money in about 14 years. The NASDAQ 100 has consistently outperformed the S&P 500 over long periods, especially during tech booms. And with only 100 holdings, you're more concentrated on the winners. The expense ratio is 0.20%, which is slightly higher but still reasonable for the growth potential you're getting. Now the concern here is obvious. Tech stocks can be volatile. QQQ can drop 30% or more during market corrections. But here's the thing. If you're investing for early retirement and you've got 10, 15, 20 years, you can ride out that volatility. The long-term trend for innovation and technology is up. Short-term swings don't matter when your time horizon is measured in decades. 4. SCHD, your dividend income generator. The fourth fund is SCHD, the Schwab U.S. Dividend Equity ETF. This is a dividend ETF with high-quality, cash-flowing companies. 10% of my investments go into this ETF. SCHD focuses on companies that not only pay dividends, but have a history of growing those dividends over time. These are mature, profitable businesses with strong balance sheets. Companies like Coca-Cola, Pfizer, Verizon. They're not the flashiest names, but they're reliable cash generators that share profits with shareholders through dividends. Here's why dividend investing is so powerful. Because one day, I want my money to pay me instead of the other way around. Dividend stocks provide passive income, which becomes incredibly valuable as you approach early retirement. You're getting paid quarterly just for holding the stock. Plus, dividend-paying companies tend to be more stable during market downturns. They've got real earnings, real cash flow, and a commitment to returning value to shareholders. As these companies grow their dividends over time, your income stream increases without you buying more shares. This creates a compounding effect that accelerates your wealth building. The performance speaks for itself. SCHD has a current dividend yield around 3.5%, and the fund focuses on dividend growth, not just high yields. Over the past 10 years, SCHD has returned over 12% annually when you include dividend reinvestment. The companies in this fund have increased dividends for at least 10 consecutive years, showing financial strength. The expense ratio is just 0.06%, making it one of the cheapest dividend ETFs available. You might wonder if 10% is enough for dividend exposure. The truth is, at this stage of wealth building, I want most of my money in growth. Dividends are great, but they're taxed every year, which can slow compounding. By keeping this allocation smaller now, I maximize growth while still building that income foundation for later. 5. BND, the Portfolio Stabilizer. The last ETF that I invest in is BND, the Vanguard Total Bond Market ETF. I put 5% into this fund. BND invests in U.S. investment-grade bonds, government bonds, corporate bonds, mortgage-backed securities. These are basically IOUs where you're lending money and getting paid interest. Bonds are way less exciting than stocks, but they serve a specific purpose in your portfolio. It helps calm the portfolio down, smooth the ride, lower the volatility, and protect your gains if the market does crash. When stocks drop 20%, bonds often stay stable or even increase in value. This negative correlation means bonds act as a cushion during market turbulence. You're not trying to get rich off bonds at 5% allocation. You're creating stability so you don't panic sell during a crash. Bonds provide predictable income and preserve capital. They reduce the overall volatility of your portfolio, which makes it easier to stay invested during scary market periods. And that's crucial because staying invested is how you actually build wealth. Historically, a portfolio with even a small bond allocation has lower drawdowns than an all-stock portfolio. During the 2008 crash, while stocks fell 37%, bonds actually gained value. BND holds over 10,000 bonds, giving you massive diversification within the bond market. The current yield is around 4 to 5%, providing some income. The expense ratio is just 0.03%, so you're getting broad bond exposure for almost nothing. If you were to start investing $600 per month across these funds, following this allocation, 40% VOO, 20% VXUS, 25% QQQ, 10% SCHD, 5% BND. By the time you turn 45, that would now be $630,000. And remember, that's assuming you started with nothing and just contributed $600 monthly. But here's the really cool part. You'd still have another 20 years to invest for retirement if you choose to. That $630,000 could grow to over $4 million by age 65 without adding another dollar. Or you could retire early, live off part of it, and let the rest keep growing. Look, early retirement isn't about luck or insider knowledge. It's about consistent investing in proven assets over time. These 5 funds give you exposure to American companies, international markets, tech innovation, dividend income, and portfolio stability. Everything you need in one simple strategy. The hardest part isn't picking the funds, it's actually starting and then sticking with it when the market gets scary. But if you can do that, if you can invest consistently through the ups and downs, you're setting yourself up for financial freedom. That's it for today. If you found this valuable, I'd love to hear which fund you're most excited about in the comments below. And hey, if you want more content on building wealth and achieving financial independence, make sure you're subscribed. I'll see you in the next one.